Hello friends, how are you doing out there? This is Vijay Bhambwani and I'm back in my weekly market outlook video. Last week when I made the thumbnail, it's retail versus the professionals. Frankly, even I was a bit skeptical. But being a slave to data and using my in-house statistical trading model, the Barracuda, the numbers were unmistakably in the favor of the markets going up. And what a week it was. The Nifty actually went to an all-time high and the Bank Nifty also recovered ground. It basically puts the bulls back in saddle. And will the upthrust continue? That is a zillion-dollar question that we are going to grapple with in this video. So let's dive right in, because this video is all about helping you take an informed decision based on facts and figures. So as you can see on the market Roundup screen, the graphic on your screen, you basically see that the indices rallied in spite of headwinds, in spite of negativity like higher oil and gas prices and mildly higher the dollar index and somewhat higher 10-year benchmark bond yields. Now these are typically negative indicators in an otherwise routine market, but last week the markets preferred to brush down these worries. Bullion rose on defensive buying, and as you can see on your screen now, the market-wide position limits, or the MWPL, fell on Thursday, which is very routine on an expiry day. Now, slowly but surely after expiry, this MWPL or market-wide position limit tends to go up. Now, that done, take a look at the basis chart. Now, the basis is nothing but the premium enjoyed by the future as compared to the spot prices. Now, both the indices, the Nifty 50 and the Bank Nifty, are showing a huge expansion in the basis. Now, this again is routine on or after expiry because the traders have a full month to play around with in the June series. I expect the basis to settle lower as time progresses, which basically also works for call option premiums. Now, let's watch the index and the stock futures volumes. Now, do note that these volumes are depicted on a cumulative series basis, which means June, July, and August series. Now, this shows a massive drop in turnover on Friday. This, frankly, worries me a little bit. Now, even if you were to discount the big spike or the peak turnover on Thursday, which is the weekly and the monthly expiry, even if you take that away, the volumes have still fallen very, very sharply, and this is not healthy for a market which is basically trading at an all-time high. This is a small worry. It need not be something that should keep you awake at night, but do remember, this definitely is a red flag. Now, this is not the only worry that should basically concern you. Let's take a look at the impetus chart. Now, this is a study that I introduced to you a few weeks ago, and this is not something that's available in the free domain. It's a product of our in-house statistical model. Now, on Friday, what you are seeing on your screen is that the impetus actually dropped, which shouldn't have happened. Now, this is statistical velocity or the statistical momentum. So even though the indices have gone up, this was showing some amount of hesitation. Does it mean that the rally is over? I don't think so. Not by a long shot. It just means that the bulls have got to try a lot more harder. And you need to watch this metric carefully in the coming days. Now, let's take a look at who's buying and who's selling. Now, here again, like the impetus, this is something that I put up on my social media accounts every single day late in the evening. And this again is our in-house study, these graphics. So do connect with me on social media and update yourself day after day where these studies are concerned. Of course, I share a whole lot of other cool stuff which is absolutely easy to understand and yet as accurate as can be to help you get ahead of the market. Now, check out the first graphic, which is the FII footprint in the market. The FIIs have cut stock futures exposure very aggressively to this chart, which is a 20-period low. At the same time, they've been raising their index future exposure to a period high. Now, this is something that savvy traders who go by building system trading's modules are most excited about all of last week. I've been in touch with a whole lot of other systems traders and they've been very kicked by this event. Now watch what the prop traders are doing on this chart. They went net short on the indices in the futures and they raised their bets on the stock futures mildly. Now that raises the probability of stock specific action in the near future because these prop traders as a category of traders tend to be the best informed about the way the winds are blowing in the market. Now let's take a look at the retail traders. Do remember that these are guys, the retail guys, they've been single-handedly responsible for taking the markets higher in the last few days. And it's their sheer buying power that's basically triggered off an up move. Now these guys, the retail guys, also went net short on indices but raised their bullish bets on the stock futures. And the net inference from all these three players, the prop, the FIIs, the retail players, and the impetus chart that I showed you earlier, is that markets are continuing to climb a wall of worry to a new high. But it's not exactly a mad one-sided buy action. The noteworthy point here is that traders are hedging their bets by shorting the indices, even if they are going long on the individual stock futures. Now, that's what you will need to watch even if you're an individual stock trader. You'll have to keep watching what these three category of people are doing on the index futures positions. Friends, let's now go to the 10-year benchmark bond yield, and in my last week's video, I promised to bring you information on the RBI's Government Securities Acquisition Program, which is GSAP, which was conducted on 20th of May 2021. Last week, I did not have the data, which was not yet released by the RBI, and the same was released 3 days ago, and the RBI bought back bonds to the tune of rupees 8,345 crores, which is a far cry from the proposed 35,000 crores. The 10-year benchmark bond yield ended at 5.99% as economic data was released. Rising yields is not just an India-specific event, but it's triggering worldwide red flags. Now, a segment of the market expects interest rates to firm up, and the governments worldwide remain the biggest borrowers, and therefore they want lower borrowing costs, which is why they are pushing interest rates lower. For a saver, there isn't really much of a choice. Now, that's not really very great news. You either accept lower coupon rates on your fixed income securities, or you might just be presented with a higher tax bill, just like the United States of America is contemplating. Do remember that the governments worldwide have been providing stimulus to the pandemic economies, and they will need to raise a whole lot of money. So either give them money at lower interest rates via the bond market, or they might just impose taxes on you. Hobson's choice, but that's the way it is. And I repeat, this is a worldwide phenomena. This is not just India specific. I promise to bring you lots more data on this aspect and also at the same time keep you ahead of the markets. The 10-year benchmark bond yield done, I now proceed to the US dollar index, which is the US currency benchmark. This index rose on 2 out of 5 trading sessions, but it remained under pressure. Though it logged 0.02% gains on a week-on-week basis, the daily chart clearly shows lower tops and lower bottoms formation, and the price is staying below its 25-day exponential moving average, which itself is trending lower. Now the 91.50 hurdle, which I had advocated last week, needs to be overcome if the bulls want to get back in the driver's seat. Now check out the weekly chart also, which shows a long leg doji and the price staying below its 25-week exponential moving average, which confirms the downward pressure on the Nifty, the Dixie, Now from here, the 91.50 acts like the first hurdle on the upside. Unless the bulls manage to push the price above the 25-week exponential moving average, don't even expect a sustainable upthrust. Now last week I advocated a range between 91.10 on the upside and 88.95 on the downside, which held perfectly well. The coming week is likely to see an estimated, I stress upon the word estimated, range between 91.05 on the upside and 89 on the downside. Friends, the dollar index done. I now proceed to the Bank Nifty, which rose on 4 out of 5 trading sessions last week. It overcame its previous significant high resistance at 34,500 as the daily chart on your screen shows. And the price is now above its 25-day exponential moving average, and it's also broken out and stayed above its triangle formation. In relative comparison with the Nifty, this index fell harder and deeper in the recent months, but it's appearing to attempt to recoup its lost ground. Now let's check out the weekly chart on your screen. The weekly candle is far smaller than the one prior to this candle. The price stays very comfortably above its 25-week exponential moving average, which shows that the short and medium-term outlook remains bullish, which is what I have been advocating in these videos based on this parameter in the last few weeks. As long as the price stays above its weekly moving average, bulls have nothing to worry about. In the week before last, this index was number 2 on the most volatile counters list, but it fell one notch to end last week at number 3 because the week's range contracted and individual stock futures showed higher beta. Last week I advocated a range between 36,450 on the upside and 32,775 on the downside, which held. Now in the coming week I expect an estimated, I repeat the word estimated here, range between 36,900 on the upside and 33,400 on the downside. I think you need to continue to trade cautiously on curtailed exposure and maintain your stop losses with absolute discipline. Friends, we now go to the Nifty, the most liquid and the lowest impact counter traded on the NSE derivative segment. Now the beauty about this index, as you can see on the daily chart on your screen, is that this index rose on all 5 out of 5 trading sessions. The price broke out above the channel top, which now appears to become a flag formation. The Nifty is now trading at an all-time high, which is called blue sky territory, because anyone having bought the Nifty at any price point is now in the money. But wait a minute, is it really so? Not if you calculate the cost of carry of the 4 derivative cycles, which is from Feb to March, March to April, April to May, and May to June, from the high that the Nifty made in the middle of February. Which is why if you add the cost of carry at a hypothetical figure of 50 to 70 points per month, the 15,600 to 15,700 levels approximately, of course, need careful watching in the coming week. The price remains above its 25-day exponential moving average. And if we go to the weekly chart now, which shows that the price remains comfortably above its 25-week exponential moving average, and therefore the short and medium term outlook remains bullish. Now, can the 16,000 round figure be tested on the Nifty? Time will tell, but as I mentioned last week, the Jensen's measure was pointing towards a positive tilt towards the bulls after a very long time. And guess what? This was bang on target. Frankly speaking, I was a little hesitant, but as a systems trader, I felt it my duty to present facts to you as the trading model, the systems trading model threw up at me. Now, retail traders took the indices to a new high, so the Jensen's measure advice turned out to be absolutely on the ball. The week before last saw the Nifty at number 7 of the most volatile list, but it fell one notch to number 8, as again was the case with the Bank Nifty, because the weekly range was somewhat smaller than the prior week and individual stocks were a lot more volatile. The coming week is expected. Now, last week I advocated a range between 15,700 on the upside and 14,650 on the downside, which held perfectly well even during the volatility. The coming week is expected to see an estimated, I repeat the word estimated, range between 15,925 on the upside and 14,950 on the downside. The Jensen's measure reading still remains tilted in favor of the bulls, but I think, my friends, you should continue to trade carefully and light and adhere to your stop losses very, very strictly. Friends, I now proceed to the most popular segment of my video, wherein I give you 5 high beta, high impetus counters, wherein you take smaller exposure and wait for larger price moves. And 5 low beta, low impetus counters, wherein you take big exposure, wait for small price moves. Now, the high beta counters list is led by Z Entertainment at number 1, number 2 HDFC AMC, number 3 Amar Raja Battery, number 4 Emphasis, number 5 Maruti. The low beta, low impetus counters list is led by Indus Tower at number 1, Granules India at number 2, number 3 Godrej Consumer Products, number 4 Balakrishna Industries, and number 5 Muthoot Finance. Friends, this hierarchy of low and high beta changes from day to day, and I urge you to stay in touch with me on my social media accounts, wherein I put out a lot of statistical data on my pages at the end of the trading session, late evening of course, and you will gain a lot by getting this data at hand. Friends, if you like this video, do subscribe to my YouTube channel. Click on the bell icon to receive instant alerts for any fresh videos being put up out here. In the comment section, do let me know what you think about this video. And in the description below this video, I've added a link to Equity Master's YouTube channel, which has a lot more videos from me at the rate of 4 videos a week, wherein I share a lot of my thoughts, my ideas, investment thoughts, which you should subscribe to the Equity Master channel for and watch my videos out there. And now on your screen are my contact coordinates. I think you should touch base with me and we'll get conversations going, help each other become better traders and earn a little more money than we already are earning from trades in the markets. Friends, thank you for your patience, for having watched my video, and I wish you have a very, very profitable week ahead till we meet again in my next weekly market outlook video. This is Vijay Bhambwani signing off for now. Take care. Have a very profitable trade. Thank you. Bye-bye.